Investing is a complex and challenging activity that requires not only technical skills and knowledge, but also psychological awareness and discipline. Many investors fail to achieve their financial goals because they are unaware of how their emotions and psychological biases can influence their choices and affect their outcomes. In this article, I will explore some of the psychological drivers behind investment decisions and how you can master them to achieve better results in the competitive investment world. Psychological drivers are factors that affect our behavior, perception, and judgment, often unconsciously and irrationally. They can stem from our personality, beliefs, experiences, emotions, or social influences. They can also vary depending on our mood, health, stress level, or cognitive capacity. Some of the common psychological drivers that can affect investment decisions are overconfidence. This is the tendency to overestimate our abilities, knowledge, and skills, and to be overly optimistic about our predictions and expectations. Overconfidence can make us trade too frequently, take excessive risks, ignore contrary evidence, or attribute success to our own skill rather than luck or market conditions. Overconfidence can also make us overreact to new information or feedback, leading to excessive volatility or reversals in the market. Overconfidence can result from various sources, such as self-serving bias, illusion of control, hindsight bias, or confirmation bias. To overcome overconfidence, we need to be humble and realistic about our limitations, seek feedback and advice from others who have different perspectives and expertise than us, and use objective data and analysis to support our decisions. Confirmation bias. This is the tendency to seek out, interpret, and remember information that confirms our existing beliefs or hypotheses, while ignoring or dismissing information that contradicts them. Confirmation bias can make us biased in our research and analysis, to stick to our initial opinions or strategies even when they are proven wrong, or to rationalize our losses or mistakes. Confirmation bias can also make us susceptible to misinformation or manipulation by others who share or reinforce our views. Confirmation bias can result from various sources, such as selective attention, selective memory, selective interpretation, or motivated reasoning. To overcome confirmation bias, we need to be open-minded and willing to change our views when new evidence or arguments emerge, seek out disconfirming information and challenge our assumptions, and consider alternative scenarios and perspectives. Herd behavior. This is the tendency to follow the actions or opinions of others, especially when we are uncertain, insecure, or influenced by social pressure. Herd behavior can make us invest in popular or trendy stocks or sectors without doing our own due diligence, to buy high and sell low based on market sentiment or media hype, or to miss out on opportunities that are overlooked by the crowd. Herd behavior can also create bubbles or crashes in the market when investors collectively act on irrational beliefs or emotions. Herd behavior can result from various sources, such as social proof, conformity bias, groupthink, or fear of missing out. To overcome herd behavior, we need to be independent and critical thinkers who do our own research and analysis, avoid being swayed by emotions or opinions of others without evidence, and diversify our portfolio and sources of information. Loss aversion. This is the tendency to prefer avoiding losses over acquiring equivalent gains, meaning that we feel more pain from losing money than pleasure from making money. Loss aversion can make us hold on to losing positions for too long in the hope of breaking even, to sell winning positions too soon to lock in profits, or to avoid taking calculated risks that have positive expected returns. Loss aversion can also make us more risk-seeking after a loss and more risk-averse after a gain, leading to inconsistent and suboptimal decisions. Loss aversion can result from various sources, such as endowment effect, status quo bias, or regret aversion. To overcome loss aversion, we need to be rational and objective about our gains and losses, use stop-loss orders and profit-taking rules to discipline ourselves, and focus on the long-term performance and expected value of our investments. Some other psychological drivers that can affect investment decisions are framing. This is the tendency to be influenced by the way information is presented or framed, rather than by the information itself. Framing can make us react differently to the same information depending on how it is worded, emphasized, or contextualized. Framing can also make us focus on irrelevant or misleading information, such as labels, headlines, or anecdotes. Framing can result from various sources, such as mental accounting, prospect theory, or availability heuristic. To overcome framing, we need to be careful and critical about the source and quality of information, to compare and contrast different frames of reference, and to focus on the substance and logic of information, rather than its form and presentation. Anchoring. This is the tendency to rely too heavily on the first piece of information we encounter when making decisions, and to adjust our subsequent judgments insufficiently or slowly. Anchoring can make us biased by historical or irrelevant information, such as past prices, initial offers, or arbitrary numbers. Anchoring can also make us resistant to new or updated information that contradicts our initial anchor. Anchoring can result from various sources, such as availability heuristic, confirmation bias, or adjustment heuristic. To overcome anchoring, we need to be aware of and question our initial anchors, to seek out and consider multiple sources of information, and to update our beliefs and expectations based on new evidence or feedback. Recency. This is the tendency to give more weight to recent information or events than to earlier or older ones. Recency can make us overreact to short-term trends or fluctuations in the market, and to neglect long-term patterns or fundamentals. Recency can also make us extrapolate recent outcomes into the future, leading to unrealistic optimism or pessimism. Recency can result from various sources, such as availability heuristic, representativeness heuristic, or hindsight bias. To overcome recency, we need to be aware of and correct for our recency bias, to look at the big picture and the long-term perspective, and to avoid chasing performance or timing the market based on recent results. These are some more examples of how psychological drivers can affect our investment decisions and performance. However, they are not the only ones. There are many other psychological drivers that can influence our behavior, such as emotions, moods, personality, values, motives, goals, etc. To understand these psychological drivers better, we need to learn more about financial psychology, which is the study of the influence of psychology on the behavior of investors or financial analysts. Financial psychology can help us to identify and measure our psychological drivers, to understand their causes and consequences, and to develop strategies to manage them effectively. Financial psychology can also help us to understand the behavior of other investors and financial practitioners, and how they affect the markets. One way to learn more about financial psychology is to read books that explain the concepts and applications of behavioral finance and investment psychology. Some of these books are Predictably Irrational by Dan Ariely. This book gives a very interesting perspective on how the human brain functions in the most irrational way, even when we deliberately try to make the best and most rational decision. The author has blended commonplace experiences with innovative research experiments to counter the common belief that humans usually behave in rational ways. While reading, you will realize how emotions, expectations, social norms, and other unseen forces make us commit the same daily mistakes. However, this irresponsible behavior is neither senseless nor random, but systematic and predictable. In short, the book states how unknown hidden forces control our predictably irrational minds during decision-making. Thinking, Fast and Slow, by Daniel Kahneman. This book primarily explains how our minds behave in a fast, spontaneous, and emotional way, or deliberately slow and logical way. It also discusses the pros and cons of both ways of thinking. The author distinguishes between two systems that drive the way we think. System 1 is fast, intuitive, and emotional. System 2 is slower, more deliberative, and more logical. The book reveals how our judgments and decisions are often influenced by cognitive biases and heuristics that stem from System 1, and how we can use System 2. The Little Book of Behavioral Investing by James Montier. This book is a concise and practical guide to behavioral investing, which explains how to avoid the most common psychological pitfalls that investors face. The author covers various topics, such as overconfidence, confirmation bias, loss aversion, herding behavior, framing, anchoring, recency, and more. He also provides useful tips and tools to help investors overcome these psychological drivers and improve their investment performance. The book is written in a simple and engaging style, with real-life examples and anecdotes. These are some of the books that can help you learn more about financial psychology and how it affects your investment decisions. However, reading books is not enough. You also need to apply what you learn to your own investing. You need to be aware of your own psychological drivers and how they influence your behavior. You need to monitor and evaluate your own performance and learn from your successes and failures. You need to seek feedback and advice from others who can challenge your views and help you grow. You need to develop strategies and habits that can help you manage your psychological drivers effectively. You need to be a lifelong learner who constantly seeks new knowledge and insights. Investing is not only a matter of numbers and logic, it is also a matter of psychology and emotion. By understanding the psychological drivers behind your investment decisions and mastering them, you can enhance your critical thinking and self-evaluation skills. This can give you an edge in the competitive investment world and help you achieve your financial goals. This article was written by me with the help of Bing Chat, a chat mode of Microsoft Bing search that can generate content and provide information. The article was also converted to speech by 11 Labs, a text-to-speech service that can create natural and expressive voices. Thank you for listening.